Here's your money briefing for Thursday, June 8th. I'm J.R. Whalen for the Wall Street Journal. Rising interest rates means higher returns on bond investments. But buying bonds isn't as easy as buying stocks. So one investment firm has introduced an automated tool to focus on bonds. WSJ personal finance reporter Imani Moise joins me to discuss how it could benefit investors. So Imani, what is Robo investing and what does it allow an investor to do?
So a Robo advisor works just like a regular financial advisor, except for it's an algorithm. So you make a deposit, you give them your money, and then they invest it for you in a mix of usually equities and fixed income to create a balanced portfolio that's automatically rebalanced.
Help us for a moment here with Bonds 101. How is a bond different from a stock?
So when you're buying a stock, you're buying a piece of a company. When you're buying a bond, you're buying that company's debt. So everyone's talking about rising interest rates. And really what that means at its core is that borrowing is getting more expensive. So if you as a bondholder are funding either a company's debt or the government's debt, that means you get paid more. And another way that they're different is that the value of stocks go up and down with the market. But as long as you hold your bond to maturity, those returns are going to be a lot more consistent and predictable.
Now, we've seen investment companies launch robo tools for investing in stocks. Why did Wealthfront decide to launch this for bonds?
Initially, robo advisors were a way to automate investing, and they followed traditional portfolio theory saying that the best way to invest is to have a diversified portfolio of stocks and bonds. But as the Federal Reserve has been raising interest rates, interest in bond investing has surged.
And who's this program geared towards?
Most robo-advisors are targeted towards younger investors, meaning investors under 40, which makes this product particularly exciting because for a lot of those investors, this is the first time that they're seeing interest rates high enough to make bond investing worthwhile and a reasonable alternative compared to the stock market. If you think about it, interest rates have been close to zero since 2008, the last financial crisis. And just when they started to pick up, we got hit with a pandemic, which sent interest rates close to zero again.
So why has robo-investing become so popular?
I think robo-investing has become really popular because of its ease of use. It's a really good way to set and forget your investments. So when you're working with a human financial advisor, typically they rebalance your portfolio every few months. But by using a robo-advisor, that's happening automatically all of the time.
All right, so how does this work? If somebody wants to invest in bonds using this robo-advisor, what would they do?
The first step when you open an account is to answer a short questionnaire. They're going to ask you questions like how old you are, what your income is, and what state you live in, because that determines the tax considerations that impact you. Next, you just fund the account, and the algorithm automatically chooses a mixture of corporate and government bond ETFs to invest in. It's paying attention to the market and seeing when the value of investments rise and fall. It's paying attention to different tax considerations, and it's making sure that the value of your portfolio stays relatively consistent to the yield that's promised and that it's minimizing any potential tax burden. I talked to one Wealthfront client who started playing with investing right after he got out of college, kind of right after the last financial crisis, but quickly realized that while he was seeing a lot of gains from trading stocks and doing things on his own, he was also paying a lot of taxes. So one of the cool things about a robo-advisor is that they do something that's called tax loss harvesting, which is automatically rebalancing your portfolio and selling when there are certain losses to offset any capital gains taxes that you may have to pay as an investor.
You know, for the investor, who would have time to do that all day?
You're right. It's a full-time job. That's why it's easier for the algorithm to do it. Or if you can afford it, using a human financial advisor.
So how is this bonds robo-advisory account different from a robo account that you would have with stocks?
So Wealthfront is marketing this as a safer, less risky alternative to its traditional investing account. It launched with an advertised yield of over 5%, which is higher than you can get from high-yield savings and a lot of CDs right now. So by putting money into the bond account, you're guaranteeing that you're going to get that rate over the short term, and it's a good place to park money that you want to save for short-term goals, like maybe a down payment or buying a car.
We talk a lot in the show about people needing to save more.
They're marketing this as another savings solution. They also have a cash account, but the yield on this bond investing account is a little bit more aggressive.
When robo stock accounts came onto the scene a couple of years ago, more investment companies introduced them. Do you expect more investment companies to introduce similar things to Wealthfront?
Definitely. I think fintech has done a really good job of bringing technology to make investing in the stock market very simple and very seamless. And now that you're seeing a renewed interest in bond investing, I expect companies to invest in making bond investing a similarly easy process.
That's Wall Street Journal personal finance reporter Imani Moise. And that's your Money Briefing. I'm J.R. Whalen for the Wall Street Journal.